Hey guys, welcome to my channel Accounts Accuracy, and let's study bank reconciliation statement today. Now, you must know why this bank reconciliation statement is prepared. Actually, any entrepreneur maintains his account in the bank, and that account, that is current account which is maintained by him at bank, must match with the bank column of his triple column cash book. His accountant also maintains his bank column in his triple column cash book. As you know, both are same account and belongs to the same person, so it should definitely match. But whenever at any point of time it doesn't match, then in that case the entrepreneur's accountant maintains bank reconciliation statement, and through the bank reconciliation statement the accountant tries to find out the reason for the difference between passbook and cash book. Passbook is the book maintained by the bank, and cash book is the book maintained by the accountant of entrepreneur. Now, I hope you might have understood why the cash book bank column of cash book and the passbook balance should match, because it belongs to the same person and it's the same account. Only the difference is that there are two accountants preparing it at two different places. One is preparing the account at bank and one is preparing in his own books of accounts. But both this passbook and the cash book belongs to same person. The account belongs to the same person. As it's been prepared by two different accountants, so it may mismatch. Whenever it mismatches, it is tallied by his accountant. Now you must know the causes of difference between cash book and passbook balance. There are two causes. One is time gap and another one is error committed in recording transactions. Maybe banker has not recorded, or it may be the accountant of the entrepreneur has not recorded. And time gap, suppose the entry has been recorded in the bank column of cash book but it doesn't get recorded in the passbook. Or sometimes it may be possible that transaction has been recorded in the passbook but has not been recorded in cash book because of the time gap. So let's see one by one. The first difference caused by the time gap is check issued but not yet presented for payment in the bank. As suppose the accountant has recorded when the entrepreneur issued the check, accountant deducted from his bank column of cash book, but at that time the check was not presented to the bank, then it wasn't recorded in the passbook. Now the money of the cash book got reduced because it's been deducted from the cash book bank balance, but as it's not been deducted from passbook, it will definitely decrease the balance of cash book, and because of that the balance of cash book and passbook will not match. Hence, what the accountant needs to do, the accountant should again add back that amount, because the amount of issued check hasn't been recorded in the passbook, and because of that the passbook balance comes more rather than the cash book balance. So when it will be added, it will definitely match with the passbook balance. Now next is interest allowed by bank not recorded in cash book. Now as you know, interest is credited in passbook, it increases the balance of passbook. But when the information hasn't reached to the accountant of entrepreneur, then the accountant hasn't increased the bank amount of the cash book. Now, as the money is not increased in cash book, but the money has got increased in the passbook, it needs to be added to cash book also in order to match the balances of cash book and passbook. The next one is amount directly deposited by the customer in our bank account. Now you see, if the money has directly been deposited in bank but there is no information to the accountant of cash book, then this accountant will not increase the money and the banker will increase the money in the passbook. Because of that, what will happen? Again, cash book balance will be less than passbook balance. So that is why it will be required by the accountant of cash book to increase the balance of cash book bank column 2. So that is why this amount will also be added to the cash book. The next one is interest and dividend collected by bank on traders' investment. Now suppose if some securities are there of the entrepreneur and the money has directly been collected by the bank, then banker will definitely increase the passbook balance. But as the information hasn't reached to the accountant of cash book, then the accountant will not increase the cash book balance. And as the cash book balance of bank column hasn't increased, it needs to be increased by the same amount. So that is why this amount should also be added to the cash book balance in order to match it with the passbook balance. The next amount is check paid into bank but omitted to be entered in book. Cash book. Obviously, if it's been omitted to be entered in cash book, it must get added to cash book also, because here what we are doing, we are just trying to match the balance of cash book with passbook. So if entry hasn't been done in cash book, so it must be added. The last one is any wrong credit given by the bank in the passbook. Now by mistake the amount has got credited in the account of the entrepreneur, has increased the balance of passbook, but as no information has reached to the accountant of cash book, there is no increase in cash book balance. Hence, that must be added to the balance of cash book in order to make it equal to the passbook balance. So, I hope you might have understood all these points. If not, please repeat the video in order to understand. Let's see why few transactions are deducted from the balance of cash book. You can see here the first one is checks paid into the bank for collection but not yet credited by the bank. Now as check paid into bank for collection but not yet credited by the bank. Now when the check was sent to bank for collection, accountant increases the amount in bank column because he know as the check has gone for collection, it will definitely increase passbook balance, and the accountant also increases the bank column amount. But as the amount has not been credited in passbook, that means the passbook balance hasn't increased and the cash book balance has got increased. So in order to match both the balances, accountant needs to deduct that value because check hasn't been credited yet. The next item is check paid into the bank for collection but dishonored by the bank. It's like the check has been paid, so accountant has increased cash book, but as the check was dishonored, passbook balance hasn't increased. Hence, it needs to be deducted from cash book again so that both the balances of cash book and passbook should match. Now, the third one is bank direct payment made by the bank according to the standing instructions of customers. Now as accountant of bank has deducted the value from passbook in order to pay the amount to the customer, passbook has been deducted, has been debited by certain amount on behalf of payment to a customer. It must be deducted from cash book also because that amount has been directly deducted by the banker due to the standing instruction. But accountant of cash book doesn't have any information about it. So when the accountant is trying to match cash book and passbook balance in bank reconciliation statement, accountant needs to deduct the value of that payment done for the customer. The next one is bank charges and commission charged by the bank. The word charge means it's deducting, it's reducing the passbook balance. Whenever you see charged amount, that means it's being debited to the passbook. Now, as the money has been deducted, needs to be deducted from cash book too. So, accountant will deduct that value of bank charges. The next one is check issued but omitted to be recorded in cash book. Sometimes, due to certain reasons, the accountant forget to enter the check issued by the entrepreneur, and by mistake the entry is not done in cash book, but the entry is done at passbook because the money gets debited to the passbook. When it was issued, it was needed to be deducted from cash book too, but by mistake it was omitted to be entered and it was not deducted from the balance of cash. Hence the accountant needs to deduct that value of check issued but omitted to be recorded in cash book. And the last one is any wrong debit given by the bank in the passbook. Now sometimes by mistake money also get debited by the accountant of bank. So by mistake if money has been deducted from passbook, that value must be deducted from cash book in order to match the cash book and passbook balances. Now this is how it is done. I hope you might have understood it. Please watch my next video to understand the entire sum of bank reconciliation statement in order to understand it better. And please don't forget to subscribe my channel and hit the big fat like button because it motivates me to make some more videos for you. Thanks for watching.